Kitco Mining's special coverage of BMO's 33rd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.
Blackwater will be a blockbuster for Artemis. This is Paul Harris at Kitco Mining at the BMO Metals, Mining and Critical Minerals Conference in Hollywood, Florida. And joining me today is Stephen Dean, Chair and CEO of Artemis Gold. Stephen, welcome to Kitco.
Thank you, Paul.
Your 190 million Canadian dollar acquisition of the Blackwater Gold Project in British Columbia in 2020 could join the pantheon of legendary transactions. It is shaping up really, really well. You recently announced the completion of an expansion study detailing an accelerated development which could see Blackwater produce more than 500,000 ounces per year of gold during its first 10 years at an all-in sustaining cost of around $700 per ounce. There's some very big and some very low numbers there. What is the potential of Blackwater?
Well, I think that one of the reasons why we did the expansion study was to enable us to talk within disclosure and securities rules and laws about the specifics of that production profile and why we see it as a rare beast, frankly, in our industry, producing more than 500,000 ounces, as you said, at around $700 all-in sustaining cash costs. You know, as an interesting aside, there are more or less a handful or so of mines in the world that produce more than 500,000 ounces a year in safe jurisdictions. There are mines in Uzbekistan, in Russia, and other non-tier one countries that produce that sort of volume of ounces. But in countries like Canada, the US, and Australia, there are only a handful or so.
And you said in the conference call you did in conjunction with the study, this will put Blackwater into the sort of top 10 by size of gold projects. And I must say, I don't think I've heard a CEO who sounds so bullish and so happy about their potential for the project as you communicated last year. You really sounded like the cat that has the cream.
Well, I don't know about that, but we're very happy with what we see with the project, and we're well on the way to executing, which is the hard thing in developing a gold mine, the execution of construction on time and on budget. We're probably around the 70% mark by the end of February through completion, and by the end of next quarter, we should be around the 90% number, and that's when we start commissioning during the summer. So we're really confident in that, and we're very excited by it.
How much of an issue has the inflationary environment been? We've seen other developments that have really had trouble with that.
Yeah, inflation is real, no doubt, and you know there's the obvious things like the cost of labor, which have approximated or are slightly higher than the CPI type inflation number. But then there are other factors, steel, and in OPEX, things like reagents and cyanide and other inputs that are well and truly outpacing a CPI inflation number for their own reasons, whether it be supply side or whether it be logistics or other factors that are way beyond a normal inflation effect.
Okay. During the call, you also, for want of a better phrase, gave a bit of schooling to analysts on valuation. What is it that upsets you about how companies are valued?
Yeah, I did get accused of being a headmaster on that call, and I didn't want to offend anybody, but I wanted to encourage analysts who perform a really important role in our industry. You know, I think you and I talked about this earlier. It's very important to get the confidence of generalist investors in this space, because there's a dwindling base of specialist investors in the precious metal space, sadly, over the last several years. So we've really got to convince the generalists that this is a sector that they can comfortably invest in and do well in. And so part of that is performing good analysis. And making sure that when you do analyze and respond to corporate updates or company statements, that there's good analysis of the numbers that are produced. For example, in that instance, what I was talking about on the call was a measure which is not often used, but we call it capital intensity measure, which is simply the capital spend divided by the throughput of any given mine, because that allows you to do a better apples to apples comparison across different developing mines. Suffice to say, I'm proud to say that the Blackwater mine, certainly on phase one, is one of the lowest, if not the lowest, capital intensity spends in our space right now.
That seems a little bit strange because in the copper space, capital intensity is something that you hear much more frequently. Capital intensity, project A, project B. It's something that's talked about a lot more. And I think you're right. It doesn't really surface in the gold space.
No, but it should. It's a really good measure. It's a measure of a company's ability to build economic propositions in new mines.
Let's talk in a broader sense about the attractiveness of the sector to generalist investors. Recent years, we've seen a number of mega deals to create big gold companies. The logic being that they get big enough to be able to appeal and attract generalist investors. Unfortunately, those companies haven't really delivered on performance. Are companies getting too big to succeed?
I'm not sure that's the case. I think the how difficult it is to operate multiple mines and how difficult it is to build new mines is not well understood. It really is challenging, and when you add to the mix, as we've experienced in the last few years, which, by the way, because inflation's been at bay for so long, we've got a generation of management in mining companies that have never had to build things or operate things in these sorts of conditions, inflationary circumstances. So I think part of it is to acknowledge how difficult it is. I think part of it is the geographical spread and diversity, particularly for the big miners, the senior miners. It's a difficult thing to do. That's why I praise companies, for example, like Kitco, because they remain really focused. They've got mines outside of North America, but their focus is very much Canada and North America. And that I think pays dividends for them because it's a simpler business to operate. If you're spread all over the world, from Africa to Australia to North America to Latin America, just the wear and tear on management as you travel around and you do what you should do to be good stewards of those mines is high.
I imagine within that context, Stephen, you're going to upset a lot of people when Blackwater comes into production at around $700 per ounce, all-in sustaining cost. You will be at half of what some of the bigger guys are. There's not really anybody that produces at under $1,000 per ounce. So that's perhaps going to distort a lot of people's view about the sector as well.
Yeah, and I think there's probably people out there that question whether we can do it. Time will tell. What I will say is that number is based on 2024 cost estimates. It's not an old cost from a feasibility in 2017 or 2019 or whatever. These are current cost inputs. So we've got a shot at delivering on that. The perhaps more relevant thing for me to comment on is, a lot of the tier one assets that sit inside the senior producers are old assets. They've been operating in some cases 20, 30, 40 years. And it's harder to operate an older mine in the low quartile of all-in sustaining cash costs because the plants are older, there's more maintenance, there's more sustaining costs. If it's an open pit, it's getting deeper, so the haulage distances are getting longer. If it's an underground mine, the shafts and the underground development are getting deeper and deeper. So all those layer upon layer add to the costs of those tier one assets. So the only way to truly achieve a low-cost mine is to build a new one, because you don't have the maintenance costs. The pit is shallow, so the haulage distances aren't far. So that's one of the reasons why I think Blackwater is going to perhaps shine for a little while, is it's a new mine.
With the kind of production and cost profile Blackwater will have, it certainly meets the definition of a tier one asset. Are you fearful that a bigger company will come hunting for you?
One of the unique characteristics of Artemis and the history of companies that I've been part of founding, including our predecessor company, Atlantic Gold, is that board and management own a significant percentage of the company. So in Artemis's case, we own 38% of the company. So that gives us a fair degree of comfort that we're in control of our destiny. And as I said, it's a fairly unique characteristic in our industry.
Extending that, with the low values that you see elsewhere in the industry, single asset developers in general in particular, do you see the future opportunity before Artemis then as buying up some other companies, developing other projects, or perhaps merging with a similar sized company that's already producing?
It's an option. I think for now we remain very focused on delivering our phase one startup. I think companies can get ahead of themselves by taking their head and starting to look above the horizon, and that causes defocusing on things that are important at hand. So I don't know that we'll be doing that. I think we want to finish the phase one for sure, and we want to get phase two expansion underway at Blackwater. If our stock price responds and we achieve a premium valuation and we're comfortable with the outlook for Blackwater, then maybe that's an option. But for now, we're heads down, and we're going to deliver or focus on delivering what we've said we will.
With production just over the horizon, what's your view of how you'll manage the company's balance sheet as and when you start developing the cash flow? Are you going to look to pay down debt rapidly, or will all the cash flow go into the next phase of development?
No, I think it'll be a good balance of all those things. I think it'll be achieving our debt service. We have about $385 million of term bank debt that is repayable over a 6-year period. And the CapEx for phase two will be spent over 1.5 or 2 years. So, our study suggests that in the first 5 years, we'll generate operating cash flow of the order of 550 Canadian dollars per annum. So that, and that's based on an $1,800 gold price. If we sustain that or better, then that'll be sufficient cash flow to comfortably service that debt and fund our expansions.
Okay. Now, Newmont, the world's biggest gold company, has made a clear statement of intent in British Columbia, where Blackwater is located, both through the Newcrest acquisition last year and more recently through the assets it said it's going to divest. Does that bring you pleasure or pain?
Oh, I agree with them. I think British Columbia is a great place to operate. It's one of the few safe and truly mining jurisdictions, and I can totally understand why they want to grow their business there.
Okay. So, Stephen, where do you want Artemis Gold to be by the end of the year?
By the end of the year, we want to have commissioned the plant, and we want to have poured gold and on our way to a stable base of commercial production.
Well, I wish you the best of luck with that and look forward to hearing more in due course. Stephen, thank you very much for joining us today.
Thanks, Paul.
And this is Paul Harris for Kitco Mining at the BMO Metals Mining and Critical Minerals Conference in Hollywood, Florida. And if you like what you see, don't forget to subscribe.
Kitco Mining special coverage of BMO's 33rd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.